Hello and welcome to Market Domination. I'm Josh Lipton, live from our NYC headquarters. Investors eye an inflation warning. Prices for wholesalers rose at the fastest pace in 3 years in July. And right now, there's just an hour to go until the closing bell, and stocks not doing much. Let's look at the popular averages. The Dow is basically flat. We're down 70 points here. I'm looking at the broad gauge, S&P 500, also basically flat. Tech-heavy NASDAQ doing the same. Just a quick peek at the Russell 2000, your small caps. They are down about 1.4%. Let's welcome in now. We got Investopedia, editor-in-chief. That would be Caleb Silver. Got Fed correspondent Jennifer Schonberger and senior reporter Allie Canal joining us to help break down all the headlines. Allie, kicking it off to you on today's trading action so far.
I think you nailed it, Josh. Not much going on here. Stocks go nowhere type of day. We have the Dow off about 70 points. S&P pretty much trading just below the flat line. We did see the S&P try and peek into the green. Those gains were relatively short-lived, and we spent most of the day underwater. But this, of course, coming after that hotter than expected PPI print like you were just referencing. It's interesting to look at the CME FedWatch futures on what markets are thinking when it comes to that September rate cut. And at last check, that's still hovering around 90%. So still a lot of conviction there that we will see that rate cut in September. But we did see that reaction when it comes to that hotter inflation print for businesses. That did play out in the bond market just a bit. We had the 10-year yields up about 6 basis points, still below 4.3%. Same with the 30-year yield, again, still below 4.9%. So nothing too crazy here. Bitcoin, because we're a bit more risk off in this market, that is down 3%. And that comes after Bitcoin hit a record high early this morning. So we're seeing Bitcoin give up some of those gains. But I want to go back to something that's been on my mind, and that's this question about market breadth. So today, you're seeing that the headline S&P is outperforming that equal weighted S&P. So that implies that those 493 stocks, all those stocks minus the Mag 7, they're doing a bit worse here. And we're seeing those Mag 7 names really prop up a lot of that market. And if we take a look under the hood of the NASDAQ 100, you're going to see a lot of that play out. So taking a look in the NASDAQ, you're going to see names like NVIDIA, Microsoft, Alphabet, Amazon, really a big pop here today, all trading in the green. But we have seen more market breadth over the past few days. If you look at small caps as well, that's been seeing a nice recovery since some of those lows that we saw earlier in this year. Let's take a look at a year to date for the Russell 2000. You can see that we're trying to come back and battle some of those losses that we saw earlier this spring. So that's something that investors and market watchers are really keeping an eye on as we track the health of this rally and also the sustainability, Josh.
All right, let's head to Washington now. Jen, rising PPI, which Allie was just talking about there, does indicate increased wholesale inflation, can complicate the Fed's decision about interest rates. What are the implications, Jen, after the results we saw?
Yeah, Josh, a hotter than expected wholesale inflation report just made the Fed's conundrum for whether to cut rates in September that much harder, raising questions about whether higher prices for businesses could be passed on to consumers, pushing up overall inflation. Producer prices jumped 0.9% for the month of July. That compared with expectations for just a 0.2% increase. That was the highest jump in more than 3 years. If we look at a year-over-year basis, core producer prices jumped 3.7% for July. That compares with 2.6% for the month of June. Now, across Wall Street, interpretations of this report have been mixed, but one thing's for sure, and that is that services inflation pushed up that PPI number. We saw a little bit of that with CPI earlier this week, but more so with today's PPI report. And this shows that there is more than just inflation from tariffs that is going on right here. Chicago Fed President Austin Goolsbee said on Wednesday that he is somewhat concerned about the services component heading up in that CPI report, and it's something that he is keeping an eye on. The next test for inflation will come on August 29th when we get a reading on the Fed's preferred inflation gauge, that personal consumption expenditures index. And economists at Bank of America expect that will tick up to 2.9% for the month of July. That would be up 0.1% from 2.8% in June. And Josh, the million-dollar question is whether consumers can stomach higher prices. With a weakening job market, if they can't, then we're probably not going to see much inflation.
Caleb, I want to get your take as well here. So as Jen very well laid out, they get that hotter PPI print, Caleb, all right, comes in hotter than expected. But I'm looking at the market reaction, and we are flat across the board here, across the popular averages. What do you make of that, Caleb, of that market response and reaction to that print? What does it tell you?
Yeah, hot and getting hotter, but Allie teased it already. It's the fact that we're probably going to get a rate cut at the next Fed meeting in mid-September. We may get as much as a half a basis point cut there. Because,
you think you could see 50?
Yeah, and I've heard Fed governors talking about that. They've been on the circuit all week, a couple of them saying maybe we need as much as a half a point cut here. Why? Maybe we waited too long here now that we have inflation piping up and we have that weaker than expected jobs report and those huge revisions for May and June. I think investors are looking forward to that. Basically, they're saying, look, these cuts probably should have happened a couple of months ago. They're probably going to get what they want, those that are waiting for a Fed cut, and that's probably why the market isn't selling off that much. And you look at the VIX right now, it's asleep in a summer nap, mid-August nap right now, down around 14. The market's down, what, 0.5% here, so not much to worry about. But this is where inflation is, in the services part of the economy. Airline passenger prices up 1%, saw it there. Portfolio management fees up 5.4%, and machinery, equipment, and wholesaling. That's what drove this inflation report.
Jen, did you have a question there?
Yeah, I just wanted to respond to the guests. You know, this notion of a 50 basis point jumbo cut in September, personally, I think is a little bit premature. I know that Treasury Secretary Scott Bessent is called for playing some catch up, but I mean, we just heard from San Francisco Fed President Mary Daly earlier this morning, and she's not prepared to do that. She does think that a rate cut is in the cards for September because the job market is moving in the wrong direction, but she thinks that a 50 basis point rate cut would be a bit much. We have seen there is one governor, and that is Mickey Bowman on the Fed, who has signaled that perhaps she could be open to that, saying that the Fed needs to be proactive. And then there's Fed Governor Waller, who has said that he doesn't want the Fed to get behind the curve. But I think that those members of the Fed are in the minority at this point, unless we saw another weaker jobs report and we saw revisions turn negative for the July jobs report. I personally don't see the Fed slashing by 50 in September.
Caleb, I want to come back to you. So we're taking a bit of a breather here, Caleb, right? But you pull back the chart, the move this market has made off that April. I mean, the SPX is up roughly 30%. What would explain that move, Caleb? If you were to unravel it, what have been the movers, the drivers, the tailwinds?
Yeah, the anticipation of lower interest rates, whether it's a quarter point cut in September or a cut by the end of the year. Investors know this is coming. You look out to 2027, and traders and investors expect the Fed funds rate to be at around 3 to 3.25%. So we know they're heading lower eventually, and investors are anticipating that. That's going to make money cheaper. Not always great for stocks, but a lot of people think that that'll induce more spending. Plus, you have really strong corporate earnings. Companies guided lower going in. They've been actually getting more positive on the way out, historically positive compared to what they usually are in terms of giving guidance. You have that going. You got stock buyback set to eclipse a record here of over $1 trillion this year. Why? Companies have no better use for their cash, so they say, and they think their stocks are still cheap, so they're buying their own stock. And you have deregulation, broad deregulation. This administration's basically opened the barn doors for basically anything goes in the risk part of the market, and that's why we've seen record highs for Bitcoin, record highs for stocks, record highs for the NASDAQ 100, and we've seen that meme stock mania pop off all over again.
Yeah, it's been a melt-up in the U.S. It's been a melt-up in a lot of places around the world. All right, thanks, everyone. Appreciate it. Well, fresh inflation data coming in on Thursday with the producer price index, the print coming in much higher than economists anticipated, throwing in a curveball at the Fed's interest rate decision in September. For more, we're beginning to hear Lauren Saidel-Baker, economist at ITR Economics. Lauren, it is good to see you. Let's start with the economic news today, Lauren. That would be that PPI print. It came in hotter than expected, Lauren. I'm interested to get your take on that print and just your broader view of inflation, Lauren. Where are we? Where do you think it's headed?
Sure. So this was actually not higher than we at ITR Economics had been expecting. We've already seen building pressure, especially on the PPI side of things. The consumer price index, we expect that one to start turning up very soon as well. We're starting to see more of these inflationary pressures, fundamental factors that have been in place for years now across the economy, just starting to impact inflation. And I want to be absolutely clear, when I talk about these fundamental factors, I don't just mean tariffs. There are a lot of other pressures, both fiscal, monetary. We see higher wage pressures. We see higher electrical, energy costs building in. So I think this is a much broader conversation. I still don't think we've seen the full impact from tariffs just yet.
And so, Lauren, now that you as an economist, you got your CPI, you got your PPI, what are you expecting for core PCE, which of course is Jay Powell's preferred inflation gauge?
Yes, so there's going to be some differences between those two, just methodologically speaking, but we do see the general direction typically align. Again, these are broad-based inflationary pressures that we're seeing just now. I see more reason for rates to be rising in order to not let inflation get away from us as it did the prior cycle than to see these rate cuts. So I think the Fed is watching very closely the movement beneath the surface. Yes, we might get a 25, maybe 50 basis points. I struggle to even see 75 this fall because more broadly speaking, inflation is the risk that's on our doorstep, much more so than the labor market. The Fed officials know that.
To the extent that we see that tariff-induced inflation, Lauren, the debate at the Fed seems to be whether that is going to be transitory, one time, or something more persistent. That seems to be a great debate among our policymakers, among our central bankers. Where do you land on that?
Well, if the Fed hasn't been scared away from the word transitory, then I don't know what it would take. But yes, there is that discussion. Is this a one-time step up in prices or something a little bit more pervasive for persistent? I think either way, those tariff price increases are not even here yet. So as we try to dissect what exactly caused this building inflation, our analysis suggests that tariffs take between 9 and 18 months to really flow through to be seen in the economic data. So whether they're one time or whether they are, again, more long-lived, these are not here yet. That does mean that we still have further inflation to go from this point in August 2025 with regards to tariffs impacting price levels.
It's interesting, Lauren, because you'll hear other economists say, listen, inflation, I mean, it is not where Jay Powell wants it to be, but they'll say the Fed now is firmly focused on the weakening in the labor market, and that's why they say the cut is a lock in September. What do you say to that?
Sure. I think the labor market is softening, but we have to remember that it's softening from such an incredibly tight starting point. We still see general balance in the market. It's just balance at a slightly lower level. So one of the metrics that I use, it's not just the jobs numbers, how many jobs were created, but it's how many unemployed workers do we have for each available job opening. Right now, that number is hovering right around 1 to 1. Typically, in a kind of normal labor market, we see multiple job seekers for each available open position. So I know this feels different than it has felt in recent years. It certainly is very skills-based. There might need to be some reskilling that takes place. But generally, we're just seeing the labor market at balance at a slightly lower level. That is fewer job seekers and fewer jobs being created, both as we have demographic challenges with labor availability, limited numbers of young folks aging into the labor market versus those baby boomers who are now finally retiring. We also have negative net immigration expected this year. That's going to limit labor availability in certain key sectors. Now, on the other hand, businesses are feeling all of this policy uncertainty. They want to play their cards closer to the vest. So we also don't see a broad swath of new job creation happening, new available positions coming up. So all this means to me is that we're still generally imbalanced. Neither side is significantly out of whack at this moment, but it's just at reduced numbers. I think that's something we're not used to contemplating with regards to, say, how the jobs report comes out. It's
interesting, Lauren, because you get that PPI data this morning, and you do hear these, you'll hear new questions raised about trust in the data. And I'm curious to get your take on that. How much confidence do you have in data?
Trust but verify has become our new motto. So we are looking for other data sets that can either confirm or deny what we're seeing from the official numbers. I'm less worried about things like the revisions. Revisions are very normal. We just get more surveys come in after that first release. So the data does get fine-tuned. That is very normal. What I'm personally more worried about is the layoffs, the force reductions at the BLS. With regards to, say, the CPI numbers, 1 in 3 data points is now being imputed in the CPI calculation. That is a big increase from what is normal. So I don't think we'll see any major, flipping of a switch from good data to bad data. It's going to be a little bit more gradual. We'll tend to start to see that discrepancy widen over time as we make more and more assumptions in the data. If anything, I'm watching the CPI most closely, and we would tend to expect inflation to be understated, if anything.
Lauren, great to have you on the show today. Thanks so much for your time.
Thank you.
Well, we are just getting started here on Market Domination. Coming right up, Oracle's plans to cut jobs is impacting its stock. We're going to explain what's going on there. Plus, AI is giving Eli Lilly a new edge. We're diving into how the technology is helping strengthen the pharmaceutical company. And Coreweave experiencing a post-earnings crash. Going to stay with us here after the break. We're speaking with the company's CEO. Now to Charles Sizemore, Chief Investment Officer at Sizemore Capital Management. That firm has more than $111 million in assets under management. Charles, great to see you. Let's start today, Charles, with the economic headline of the day. That was a PPI print, hotter than expected. I'm curious, Charles, you saw that headline. What did you make of that report as a CIO, Charles?
Sure. Well, the first thing to remember is the PPI number is notoriously noisy. It tends to be a lot noisier than, say, CPI. That said, when you see a core PPI number that is the highest it's been in almost 4 years, that's really a wake-up call. Now, where it gets more interesting is when you dig deeper into the data. The first thing anyone's going to immediately think is, oh, this must be the tariffs finally showing up in prices, right? Actually wrong. We still have yet to really see much of an impact from the tariffs. Most of the surge in the PPI was due to a surge in the cost of services. Now, that could be tied more to immigration. We have had an estimated 2 million immigrants self-deport in the first half of this year, so that clearly exacerbates an already tight labor market. But yeah, that number is certainly not one we wanted to see. It also changed the calculus for the rate cut. So if we had had this conversation yesterday, I would have told you that the market was pricing in a 100% chance of a rate cut in September and a 10% chance that the Fed cut by 50 basis points as opposed to just 25. Now, today we're seeing very different numbers. There's been a swing where we're still seeing a 90% probability of a rate cut, but about I guess it's been revised to about a 7% possibility that the Fed just sits tight and doesn't cut at all.
Charlie, let me get your take. Let me get just your take on a different way to look at things. I'm curious to get your perspective on this. You get the PPI print, Charles, and as you said, not what you wanted to see. It was hotter than expected, and yet I look at the market response, Charles. We are flat across the board. It is a giant yawn. In fact, I look at the SPX. We actually ticking modestly higher here into the close. I wonder what message the markets is sending me there, Charles. Could it be, I'm going to bounce this off of you, that the markets could be telling me, you know what? Maybe we're actually going to be fine. Maybe the economy's okay. It's, to use a word we've used a lot on this show, it's looking resilient. What do you make of that?
Well, the biggest story this earnings season has been earnings. The U.S. market, led by the tech sector, really is killing it right now. Earnings have been really good. And a single month blip in the PPI doesn't really change that. Now, we still have very significant risk, of course, but does 1 month of PPI that it could be statistical noise, does that really change the earnings picture? No, it doesn't.
Jay Powell speaking at Jackson Hole. As a CIO, Charles, you're going to be listening. What are you listening for there?
I would not want that man's job. That talk about a thankless job. We're looking for any indication of what his plans are. He's hinted that probably a rate cut in September is likely, though he's hedged his words to where he gives himself a little bit of wiggle room there. We're looking for really any indication that he's going to do anything other than cut rates by a quarter point. Any indication he might cut by more, any indication he might hold off for a bit, and then some guidance as to what he sees for the rest of the year. But I know that he's as confused as the rest of the market right now. Powell is anything if not transparent, and he's the first one to say he doesn't really know what to expect. He's taking the data day by day.
So Caleb, I want to bring you in here. What Charles is saying, when Powell speaks, he's listened for, does the Fed chief say anything other than, hey, I'm going to cut by 25 in September? What are you listening for?
Yeah, he's not going to say that. We know that for sure, but he's going to start to say that we're starting to see evidence of the potential impact of what tariffs can look like, but we need more data. We'll get more data between now and the next meeting, and he'll go back to fly fishing. What I'm curious, though, for you, Charles, you talked about earnings and the strength of earnings, and that definitely has been one of the propellants of the market. But as you look at the metrics within the earnings, we know a lot of that's top-heavy in AI and mega cap tech, but what are the key metrics that you're focused on to tell you that this is actually a healthy earnings season across sectors?
Well, no, you made a good point. It's extremely top heavy. The Mag 7 and the handful of AI driven stocks, they're pulling everything higher. If you look past those, it's a much weaker picture. But it really boils down to what matters today. The Mag 7, the core. It's not really the Mag 7 anymore. Call it the top 10 or so tech stocks. Everything moves based on their movements. They move the market higher, they move the market lower. Nothing else really matters right now. What I'm concerned about in the quarters ahead, of course, is that those companies run out of steam, as perhaps we see some overcapacity in parts of that story. But in the immediate short term here, it's just we live and die by the Mag 7. We live and die by big tech.
Charles, so let's finish here, add it up for us. Given the backdrop, the environment we find ourselves in, Charles, your clients come to you, they're looking for advice. What are you telling them, Charles? Broadly, how do you want to be positioned here?
We are being more conservative than usual. We are keeping a little bit more cash than usual. We are keeping some hedges in the portfolio, but the fact is the market's trending higher right now, and there's no reason to fight that trend. This will eventually run out of steam. Like all booms eventually, reach their limits. We're not quite there yet. We may hit that limit this year, early next year. We'll see. But for now, the momentum's strong. We should participate in that.
Charles, good to see you as always. Thanks for your time. Got time for some of today's trending tickers. We're watching Oracle, Eli Lilly, and TeraWulf. Still with me, of course, Caleb Silver, Investopedia editor-in-chief. We're starting with Oracle plans to cut jobs in its cloud division as the company works to control costs as they spend more, of course, on artificial intelligence. This is according to reports. Caleb, Oracle here, Bloomberg noting cutting jobs in the cloud unit, impact the workers. They say we're told this week. Some were related to performance issues. The unit continues to hire. Report does say 150 jobs were cut in the Seattle area. Full scope reductions. Doesn't sound like we could determine just yet. Of course, Oracle stock, it has been a monster. It's up about 50% this year already. And you know what? Most on the street still say it's still a buy.
Yeah, well, it's 150-ish jobs that we know of right now. But listen to the drumbeat coming out of these big tech companies. Microsoft, 15,000 or so layoffs. Meta announcing several thousand layoffs here. They overhired coming out of the pandemic, and they hired a lot during this build out of their cloud infrastructure and of their data and their AI teams. And now they're paring back. The most significant metric right now throughout Silicon Valley and among tech investors is revenue per employee. Who is squeezing the most revenue out of each employee? And at the top of that list is just who you think it is. It's NVIDIA.
How much do we know?
It's NVIDIA, something like $2.5 million per employee, just given the incredible profit margins that it generates. So all these companies are trying to get to those types of numbers where they are squeezing the most out of the least people that they can. This is the productivity gains. This is the promise of AI. And this is what also shareholders have been rewarding them for. So not a surprise. And I think we're going to hear more of this. We've had something like 150,000 tech jobs cut already so far this year, on top of about 230,000 last year.
Wow. All right, moving on. Here's another name on your radar. Eli Lilly is in the green as the company signs a $1.3 billion deal, teaming up with Superliminal Medicines to develop new treatments through AI to treat obesity and heart-related diseases. It's okay, but it sounds like Superliminal gets up to $1.3 billion. Lilly gets rights, per reports, to develop and commercialize compounds arising from the collaboration.
Yeah, well, congratulations on you for saying the name of the company right more than one time.
Don't ask me to say it 10 times fast.
Right, but look, this is the space that's hot right now. Weight loss drugs, mood-altering drugs that help with weight loss, and also using AI for the discovery of that. Not a lot of money for Lilly to get into that space and deeper into that space. All these drug companies are looking for the next blockbuster, and all the blockbusters have come from the weight loss space over the last few years. Not a surprise here at all. Pretty good deal for the company whose name I cannot mention because I don't have your skills, but we're going to probably see more deals like this. Combining AI with the most advanced therapeutics for the hottest drugs on the market makes perfect sense.
Separate headline, Eli Lilly raising the list price for its obesity shot in the UK by as much as 170%. Apparently that brings rates in line with other countries. New price still below apparently the level here. Finally, let's hear on Bitcoin miner TeraWulf soaring at the announcement that Google will take an 8% stake in the computing provider. The announcement is part of two 10-year contracts TeraWulf just signed with cloud operator FluidStack. Google is backing TeraWulf for $1.8 billion of FluidStack's lease obligations. It's basically guaranteeing the project gets financed. What do you make of this one?
This is all about data storage. Data storage for high-intensity computing, high-density AI computing. That's basically what TeraWulf does. It has these incredible data centers, good technology, and they're going to need more and more of it. It's a zero-sum game out there for these big superscalers that want to control the AI conversation and the ecosystem. They have to have power and they have to have storage. TeraWulf is a good solution for Google in this department. Again, Alphabet has a lot of money planning to spend on a company like this. Money well spent, probably because they're going to need as much of this as possible.
Nice run for TeraWulf this year. Just looking at how analysts think about it, I got 11 buys, one hold, no sells on the street. Newest installation, meanwhile, of Trumponomics is here. We're talking with Yahoo Finance's Rick Newman up after the break on market domination. AI cloud computing company Coreweave reporting worse than expected earnings. The Coreweave CEO spoke to Yahoo Finance's Julie Hyman over the company's second quarter earnings call and plans to reach profitability.
I couldn't be prouder of what the company has accomplished this quarter. We have, we beat expectations by a significant amount, over 12% this quarter. We raised our guidance for 2025 by 5%. Remember, we're already more than halfway through the year, and we're still raising a full 5% for 2025. The company is hitting on all cylinders, and it has been an incredible exercise in execution at our company to continue to build and deliver the infrastructure that the world requires in order to drive artificial intelligence. And it's always strange for a CEO to get on and kind of talk so positively about what's going on at the company when the stock has clearly gone through such a significant pullback. And in my mind, the pullback is entirely caused by the lockup release that occurs at 4 p.m. today and will be done. And so the performance of the company, there was $1.2 billion in revenue generated in Q2, of which there was $200 million in net operating income. So the fundamental building blocks of the business are incredibly strong. It really was a blowout quarter for us. The stock's going to do what it's going to do in the short run. Lockup comes off. It's a moment in time. And then we fully expect, or at least I fully expect, that the company will revert to reflection of the fundamentals of our business, which are, in fact, extraordinary in an industry that is growing at an unprecedented rate.
Michael, first of all, I have to give you credit. A lot of executives will come on with me and I'll ask about the stock and they'll say, oh, I'm not paying any attention. So kudos to you for at least acknowledging the reality here. I want to linger on the lockup for just a minute because I'm curious what you expect in terms of insider selling. And I'm curious if you yourself intend to take some profits after the run-up that we've seen in the shares.
Sure. So look, when a lockup comes off, it's an opportunity for people who have invested and supported this company from when it was in when it was in the single digits of millions of dollars. And they have been supporting us and helping us build this company and giving us access to their capital. So certainly some of these early investors, many of them are individuals, not even funds, are going to take some off the table. It's appropriate. It's the right thing to do. And so we fully expect that to happen. However, having said that, we think it is a relatively small number of sellers that were going to come through and sell blocks of stock. We think that it is going to be a non-event. We think it's going to clear through very quickly. The supporters of this company are investors who understand the position of this company and the role that it's going to play over the next 10 years. And so, yes, I do pay attention to the stock. My employees do pay attention to the stock, but I do think that the employees and the shareholders that have supported this company up to this point really are focused on where is this company going to be in 6 months, in 9 months, in 5 years. And when you look at it through that lens, the stock is going to do what it's going to do. I come from a Wall Street background. I understand the trading of it. I understand that people are shorting into the expectation that they'll be able to cover their short with these new shares that come to market as the lockup releases. And I expect that there'll be less than people expect, and then it will move back towards value for the execution that we've been doing.
So, Mike, let's talk about then sort of the backdrop beyond what we're seeing in the shares, because it seemed like there was some concern being expressed as well about the spending that the company is doing to grow. Obviously, you're seeing growth as well. How should we be thinking about that spending cycle, sort of how long it lasts at this kind of volume?
So our company is relied upon by the largest, most important consumers of compute in the world. It is the leading AI labs. It is the hyperscale clouds. It is the tech-forward enterprise clients. The folks that really require computing power to move their business forward. It's the people who are building the future and the companies that are building the future. And it's a privilege to be able to be one of a relatively small number of companies that are able to build infrastructure at this scale and of this quality that allows the artificial intelligence that will drive the world for the next 50 years to be built on our infrastructure. We're really excited about that position. We will continue to invest in that.
President Trump may be coming for the data keepers and economists, but to what end? Our senior economist, Rick Newman, joins me now to discuss his latest story. Rick, to what end?
I think what Trump's trying to do here is create an alternative economic narrative. And, Trump does have a few serious economic people in his orbit. Scott Bessent, the Treasury Secretary, he understands markets, he understands the economy.
Kevin Hassan's got his PhD in this
yes,
stuff.
he does. There are a few others. And, they must know the same thing all the other economists know. And we're talking hundreds of economists now who are basically in unison saying we're going to get a slowing economy from the tariffs, we're going to get less hiring, we're going to get a hit to corporate profit margins. Some of this is starting to show up in the data. So what has Trump's reaction been so far? When he fired the economist who oversees the jobs report, she also oversaw the inflation report. He's nominated this other guy who was a conservative economist. He's putting his guy, Stephen Moran, into one of the temporary spots on the Federal Reserve Policy Committee.
And Tony for BLS.
Yep, and Tony for BLS. He's always raking Jay Powell, the Fed chair, over the coals. So I think what Trump is doing here is anticipating. I mean, he's probably got his economists telling him, we are going to see a deterioration in the economic data, not necessarily depression, but we're going to see negative trends. And he's trying to create this other storyline, which is, things are actually much better. Let's, his nominee for the Labor Department jobs suggested we should just stop publishing the jobs report for a few months. Why not forever? Now, I don't think Trump's alternative narrative on the economy is going to work. I mean, you can't really fool markets, and there's a lot of data in the private sector. But we are getting this battle of the economists shaping up.
I think it's interesting too, Rick, just on this point about economic data. Like when the PPI data hits this morning, you do have these questions being raised, and you'll hear them, whether you trust the data, whether you have confidence in the data. It is a question that's raised more now. I wonder, I'm going to put it to you like this. Do you, not whether you trust the data, but do you think there's room to, for example, rethink BLS data or BLS methodology, given the revisions?
There have been methodological problems for a long time, and some of those are getting worse. But I think about this in two ways. Number one, the data that we're seeing so far, it gets revised, it gets a little bit better, a little bit worse. That's a normal thing. The data we're seeing so far basically is exactly what you would expect to happen if you impose a new 18% tariff on $3 trillion worth of imported goods. You make stuff more expensive. It is going to have effects throughout the economy, number one. So what we're seeing, it does make sense. I mean, it's logical. Number two, ordinary people, voters and consumers, they're not sitting at home saying, oh, the PPI was 3.9 or 3.1 or 2.9, is it up? They don't pay attention to most of this stuff almost all the time. What they pay attention to is what do groceries cost on store shelves. They care about gasoline, and that's in their favor right now. Gas prices are down. But they care about, are they getting ahead at work? Are there job opportunities? Do they hear about layoffs? Do they see layoffs happening in their community? One person gets laid off in a small town, and everybody knows it. 5 people get laid off, and that town is in a recession. So these things are likely to start happening. I'm not predicting a recession. I don't think that's what most economists are saying right now. But Trump has a problem with the economy, and you can't just make up your own statistics and try to convince voters that they're better off than they are.
Is there a world in which you think we might just get maybe 3 reports from the government going forward? The American Prosperity Report, the American Happiness or Wealth Report, where all of a sudden, literally, the data that we get both as journalists and as the American people, as taxpayers, is limited to just what they want us to see?
I think it would be called the Golden Age Report. That's the phrase that Trump's working with. It's a new golden age in America. Who knows what? Trump has done a lot of things nobody thought he would do. I guess he could try. I think it's going to backfire immediately. If you create even more uncertainty and you make it harder to even gauge where the economy's going, the bond market is the first place this is going to show up. Nobody can fake out the bond market with happy talk. The bond market doesn't like uncertainty. When the bond market is in charge, stocks follow. And what are companies going to do? Are companies you can't fake the companies that a CFO and a CEO looks at, the numbers they look at about their own companies, right? So they're going to start laying people off if they have to, and everybody's going to know. So it's just going to become even more dystopian if you have a president and five partisan economists saying everything's great while people are standing in bread lines.
Rick, thank you, my friend, as always. Appreciate it. Next on Market Domination, cryptocurrency, overvalued, and should it be in your 401k? Stay tuned for that. Cisco reporting fourth quarter earnings that came in slightly beating consensus expectations, including a rise in the company's overall revenue and AI infrastructure orders. And Yahoo Finance's Brian Sozzi spoke to Cisco's chief financial officer about the company's quarter and cautious outlook for the remainder of the year.
I think it was a really solid quarter, so I want to thank the teams for the execution during the quarter, particularly with my first quarter as CFO. It was a beat on both the top and bottom line. Revenue came in at the high end of our guide, so did gross margins and operating margin, and then EPS came in above the high end of our guide. So really pleased with the performance during the quarter. We saw, very balanced growth across all of our geographies. We also saw growth in each one of our technologies as well. So, very, very balanced quarter. As you mentioned, a lot of strength in networking. Revenue grew 12%, and that's frankly where I think a lot of the tailwinds are today that we're seeing, and we can certainly talk more about that. Security also, showing I think real solid improvement there, and a lot to be excited about in terms of where we're taking that portfolio over time.
All right, what's the biggest driver? I'll follow up on the networking business, Mark. What's the biggest driver of that networking business, and how do you see it moving from here?
Yeah, so if you think about it, I would say AI is really the biggest driver in terms of the overall umbrella. When you look at the web scale space, certainly the training build-outs that they're doing in the back end has been a big tailwind for us, and we can certainly talk more about that. We took over $800 million in orders in the quarter, exceeded our original target that we had put out for the web scalers and that AI backend build out of $2 billion. We put out a target of $1 billion and actually came in over $2 billion, so more than double our original target. Then as you look at the neo cloud build outs, the sovereign build outs, those are still really yet to come for us. The enterprise space is still very nascent, but we think will ultimately be a larger opportunity than what we're seeing in the training build outs with hyperscale. And then frankly, what you're seeing a lot of right now is enterprises really preparing for AI and the applications that they will ultimately deploy. So while some have already started, you're seeing them upgrade their network, upgrade their security posture, et cetera. And so that's going to be a really good thing for Cisco as well.
Mark, people that I have talked to that cover Cisco have told me that Splunk, that $28 billion acquisition that you closed more than a year ago, demand has started to slow down there after Cisco's acquisition. Can you comment on that?
We really haven't seen that. Splunk continues to perform at or above our expectations, both on the top and bottom line. So really encouraged by the performance there. We've done a lot to integrate the teams. We've done a lot of integration in terms of the product development, but also bringing the sales teams together now. One of the things that we saw as a real nice pickup in terms of why we wanted to do the acquisition was bringing this go-to-market together in the last 2 quarters. Each of the last 2 quarters, we actually have over 300 new logos in both Q3 and Q4. So the teams are working together, the incentives are really aligned, and I think that we've got a better, more complete offering for our customers.
I'm asking all CFOs this one, Mark. I'll put this one to you. What have you done in the past 90 days to mitigate the tariffs that the Trump administration has passed through? I mean, Cisco's a global company, of course.
Yeah, we've done a lot, as you'd expect, actually. So we've got a world-class, global supply chain, and I think this is one of the places where our scale actually is an advantage for us. So the teams have been working hard. We laid out the very specific assumptions, if you will, that underpinned our guide as we move forward in terms of tariffs. It was really just a slight headwind in Q4 and also for FY25, and we'll continue to work those mitigation efforts as we get more granularity in terms of what to expect going forward.
Bitcoin touching a record earlier today, popping over 124,210 before trending lower. Cryptocurrencies have been on a tear of late, benefiting from policies out of the Trump administration and more mainstream adoption. Soon Americans may even find crypto in their 401ks. But 48% of Investopedia readers say crypto may be overvalued here. The asset ranking just below AI stocks in a new sentiment survey. Caleb Silver, still with me here, Caleb. All right, let's start there. Investopedia fans, walk me through. How do they feel about crypto?
Yeah, still skeptical. That said, more readers than ever own it than used to. We have about 27% of our survey respondents saying they now own cryptocurrency. Most of that is in Bitcoin, and it seems kind of irresistible when you look at the price trends. I just did a thing looking at the 10-year track record. It's up 44,400%.
Not bad.
How are you doing? Are you not entertained? But the streets are paved with crypto in Washington, D.C. This is what the administration wants, even though Treasury Secretary Bessent's saying they don't intend to buy Bitcoin for the strategic reserve. They
By the way, on that Bessent headline, in your opinion, big deal, no deal? Were you surprised by that?
I was happy by that.
Yeah.
I really don't want our Treasury buying Bitcoin out on the open market. That said, he did say that the U.S. has some $19 to $20 billion worth of Bitcoin from all those asset seizures. So we don't necessarily want that in as a growing part of our reserves, especially if we're going to be dollar denominated going forward. And I think when you think about who owns Bitcoin, most of the Bitcoin is owned by about 50 whales out there, and having the U.S. insert itself into that conversation in a bigger way, probably not a great strategic policy move. That said, we are going to see Bitcoin in our 401ks. You can already buy it tangentially through the spot Bitcoin ETFs or by investing in a micro strategy.
Is that a good thing? More options, more choices for people?
In a way, you get more diversification in your portfolio and the potential for more upside. You also get some potential hand grenades in there that could blow up, and you have to have a very strong stomach for investing in Bitcoin, especially for the long term, and be ready to deal with the dips. But if you've had it in there, even as a 5% allocation in your portfolio over the last 5 years, it's it's helped quite a bit, even though it's put you through some nauseating moments. And the fact that we're also going to get private equity in there, also another risky asset by definition with less transparency. This is a time more than ever that investors, long-term and retirement investors, need education, because a lot of people still don't understand these asset classes and what they can do inside a portfolio.
The recent move higher in Bitcoin, what would you chalk that up to, Caleb? Would you say that's the regulatory backdrop getting friendlier? Is it institutional demand? What is it?
Yeah, all of the above. And the fact that institutions really haven't totally embraced it yet, outside of the BlackRocks of the world that have some $75 billion worth of Bitcoin. Fidelity, we know, has been deep into Bitcoin for a very long time. But you're going to start to see the traditional asset managers start to offer it more, start to offer more options in investing in cryptocurrency, particularly Bitcoin. There's that. There's the fact that if you're looking at the regulatory highway, all you see is green lights from this administration. They want to be in it, they're in it themselves, and we know that's going to be a broader part of the capital market. So people need to understand that this is where it's going to go, whether or not it's backed by anything or what happens if you lose your crypto. All those questions about the security of crypto and Bitcoin itself still remain in question, which is why more than half the country still is very skeptical about it if you look at the recent
And you own
Gallup polls.
Bitcoin.
Of course.
To be clear.
I've been buying it, and I've been buying it for years. I wish I would have bought more of it for years like a lot of other people, but I want to understand the asset class. I want to understand the way it works. I want to understand how it actually fits into my portfolio and what happens when we get a big surge like the one we did. How does that change my risk profile when I'm looking at my retirement portfolio?
One question for you. In terms of the role Bitcoin plays in a portfolio, Mike Novogratz puts it like this. He says, it's digital gold. I've heard Novogratz say that it's digital gold. Don't overthink it. It is simply, Novogratz argues, it's a hedge against irresponsible fiscal policy the world over. Is that how you see it?
That's one of the ways that I see it. I also see it as a potential upside trampoline when I need better performance. Sometimes it's coming out of cryptocurrency, but it is a small percentage of my portfolio. I've made a rule to never make it over a certain amount in terms of percentage, in terms of its weight in my portfolio, because I have other things that I need to worry about here, and it's still being developed. It's still mysterious, but it is one of those scarce assets. It is the OG of cryptocurrencies. It's not like it just got here. It's just going to get a much more hospitable environment in this country to be a part of our capital markets one way or the other.
Digital gold, upside trampoline. All right, while we were wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.